Welcome to Digitide Solution Limited Q2FY26 earning call. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Jyoti Singh. Thank you, and over to you.
Thank you, Hina. Hello and good morning to everyone. On behalf of Aryan Capital Markets, I thank you all for joining into the Q2 FY26 earnings conference call of Digitide Solution Limited. Today from the management, we have Mr. Gurmeet Chahal, he is the CEO, Mr. Suraj Prasad, he is the CFO, Mr. Rajesh Lachhani, Head Investor Relations and M&A. So without any further delay, I will hand over the call to Mr. Rajesh Lachhani for his opening remarks. Over to you, sir.
Good day, ladies and gentlemen. Thank you very much, Jyoti, for hosting Digitide Solutions Q2 and H1 FY26 earnings conference call. We will begin with a brief overview of the company's performance, after which we will open the floor for Q&A. During the call, we will be making some forward-looking statements. These statements consider the environment we see as of today and carry risks and uncertainties that could cause the actual results to differ materially from those expressed in today's call. We do not undertake any to update any forward-looking statements made in this call. With that said, I'll now turn over the call to Gurmeet Chahal for his opening remarks. Over to you, Gurmeet.
Thank you, Rajesh. Good day, everyone, and thank you for joining us for our Q2 and H1 FY26 earnings call. I also want to take this opportunity to wishing you and your loved ones a very blessed Guru Nanak Jayanti. Before diving into our results, I want to reiterate our 3x3x3 strategy, our roadmap to triple our revenues to $1 billion by FY31. This strategy centers on 3 potential verticals in each geography, powered by 3 integrated service lines, positioning Digitide for scalable, sustainable growth. Hope our investors will remember that FY26 is a year of transition and transformation for Digitide. Our investments in establishing Digitide as a standalone company, bringing in new leadership, and building advanced capabilities are deliberate and extremely necessary. While these actions have a short-term impact on our margins, they are critical to our long-term strategy and future success. We are laying the foundation for an agile, innovative, and future-ready organization.
This call will be recorded.
The green shoots are already evident, which I will cover shortly. These investments will enable us to capture new opportunities, drive operational excellence, and deliver sustained value for all stakeholders as we move forward. This strategy has 5 key execution pivots. First and foremost, strengthen leadership. We've brought in industry experts, ensuring disciplined execution and strategic clarity. Second, talent and culture. We are investing in top-tier talent and fostering a performance-driven, innovative environment. Third, streamlined organization structure. Integrated teams that deliver end-to-end solutions, capturing larger wallet share and improving margins. AI-first transformation is the 4th pivot. We have gone all in on AI. We are embedding AI across our delivery models, thereby elevating productivity and service quality, and AI is also an enabler for all new business that we are winning. 5th pivot is strategic partnerships and acquisitions. We are expanding capabilities and market access through partnerships and actively looking at potential inorganic targets. Now let me walk you through the Q2 performance highlight. Consolidated revenues reached 760 crore, which is up 4% sequentially and 7% year-on-year. As we had mentioned at the beginning of our strategy and beginning of our financial year that we want to grow our tech and digital revenue and our international revenues, I'm very pleased to share that our tech and digital segment revenues surged 60% sequentially and 23% year-on-year, now contributing 30% of our revenue, up from 27% in the first quarter. This is driven by strong demand for AI-led transformation and digital solutions. The investments that we made upfront have started to pay off. Our international business increased 6% sequentially and 4% year-on-year, now accounting for 37% of the total revenue, up from 36% in Q1. The domestic business remained resilient despite some macroeconomic challenges. EBITDA stood at 85 crores, up 3% sequentially with margins stable. Adjusted PAT was 17 crores, reflecting selective investments in capabilities and talent. In the first half, our revenues have crossed 1,500 crores, so it's a milestone for us. So we are up 6.4 Y-on-Y, underscoring the impact of our new structure and strategic investments. We have a very strong sales momentum. We booked 550 crores in TCV. So for the third straight quarter, we've booked TCV more than 500 crores. In this quarter, we also acquired 24 new logos. We have also become the Tier 1 partner for both AWS and Azure within a very short time, which is actually a testament to our capabilities and the investments that we made. This unlocks deeper collaboration and early access to next-gen AI/ML innovation, accelerating our ability to deliver faster, smarter, and more secure outcomes. We have also expanded our AI Center of Excellence in Bangalore, accelerating proprietary platform development. Team Digitide won world's largest Google Agentic AI Hackathon, and our conversational AI solutions are now live across 20 plus customers. We have also launched on a very large upskilling program. We call it DigiWave. In phase 1, we are upskilling 10,000 professionals for AI scale. We have also been recognized as a major contender in 6 Everest Peak metrics. This is a testament to our growing capabilities and market impact. The 6 are 2 in customer lifecycle management, 1 for APAC, 1 for global markets, 2 for payroll, again APAC and global markets. In fact, in the payroll business, in addition to being a major contender, we are also a star performer. And the third is in insurance. We are a major contender both in technology solutions and BPM solutions. Outlook on growth and margin expansion. We remain committed to accelerated growth and unlocking higher margins through 5 strategic levers. Number 1, elevating our service mix by increasing the share of technology and digital offerings that deliver scalable profitability. As I said, we've already made rapid strides on that front. Second is accelerating international expansion to capture premium pricing opportunities and diversify revenue streams. Good progress has already been made on that. Third is driving operational excellence through automation, process optimization, and rigorous execution. This will always be an ongoing exercise. Fourth is enforcing disciplined deal qualification and structured pricing to safeguard margins and ensure profitable growth. At the same time, through this, we will increase our win rates. Fifth is maximizing capital efficiency through strengthened revenue assurance and improved cash conversion. I want to take this opportunity to thank our employees, clients, and stakeholders for their unwavering support. Together, we are building Digitide into a global leader in AI-first, tech-enabled business solutions. The future is bright, and I am confident we will continue to outperform and set new benchmarks in the quarters ahead. With that, I'll hand over to my colleague Suraj, our CFO, for a deeper dive into our financials. Over to you, Suraj.
Thank you, Gurmeet, and good morning, everyone. I'll take a few minutes to cover the updates for the quarter, what moved the numbers, and where we are leaning towards in the second half. I'll start with the financials and give you a walk through how this is translating into the momentum for the next half of the year. First, on revenue. In quarter 2, we delivered a revenue of 764 crores, a 4% sequential and 7% year-on-year step up. It is our third straight quarter for forward movement, driven by higher share of revenues from tech and digital, as Gurmeet alluded to, where we have been deliberately leaning into and investing. The segmented details. The BPM segment posted a revenue of 536 crores, broadly flat compared to the prior year and the prior quarter. This segment was resilient for us despite persisting softness in the BFSI segment. The segment reported an EBITDA of 84 crores with a margin of 15.6%. As highlighted, tech and digital displayed strong momentum in this quarter, with the segment reporting a record revenue of 228 crores in Q2, with robust quarter-on-quarter growth of 16% and year-on-year growth of 23%, mostly driven by AI-led transformation. The segment reported EBITDA of 22 crores, up 16% sequentially, with a margin stable at 9.6%. For the half year, as highlighted earlier by Gurmeet, Digitide reported revenues of 1,500 crores for in the 6 months. First time we are crossing 1,500 crores milestone, up 6.4% year-on-year. Our quarter 2 FY26 EBITDA came at 85 crores for the quarter, an increase of 3.1% sequentially, with stable EBITDA margin of 11.1%. Adjusted PAT was 17 crores and the reported PAT was 3 crores. The bridge from adjusted PAT to reported PAT is towards our demerger related expenses, including legal and professional fees of 11.4 crores and the stamp duty of 2.4 crores. Reported PAT in this quarter also includes taxes from dividend from one of our subsidiary, Already Technologies. And both our quarterly and half-yearly results reflect our selective investment in capabilities, talent, offerings, and our new corporate structure as an independent listed company. These investments are critical to position the organization for achievement of a long-term objective of reaching 1 billion revenue. Hence, they render a year-on-year comparison for the previous year, when we were not a listed company, less relevant. The cash conversion in H1 was impacted due to the demerger-related contract innovations, new GST registrations, etc. However, we continue to maintain a strong balance sheet and remain well-funded with a quarter-end cash of 77 crores, a gross debt of 49 crores, and therefore a net cash of 28 crores. As guided earlier, with Q2, most of our demerger-related transitions and exceptional costs are now largely behind us. And going forward, we are going to focus more on the operating rigor with clear levers, as Gurmeet highlighted. Our focus on pricing hygiene, deal qualification, improving our cash conversion cycles, process automation, and upskilling talent continue to compound. Happy to share that most of these investments across people, capabilities, and platforms are progressed ahead of time, which gives us confidence for a better delivery in the coming quarters. Quarter 2 reflects disciplined execution and strong momentum. Our tech and digital mix continues to rise. Bookings remain healthy, and our balance sheet provides flexibility for future growth. We are completing the final phase of our internal tech transition under the One Digitide strategy, with most of the enterprise applications now goes live ahead of time. Our approach, price for value, automate scale, and accelerate closures is delivering results. With larger AI-led international pipeline and sharper portfolio choices, we have clear visibility to stronger earnings in the second half. Thank you for your continued trust, and we position for sustained growth. With that, I will hand it over back to the moderator for Q&A. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhananjay Mishra from Sunidhi Securities. Please go ahead.
Yeah, good morning. Thanks for the opportunity. Sir, when we, in the presentation, we have given this 3 into 3 strategy, where we're talking about reaching 1 billion revenue in next 5 years, and we will be improving EBITDA margin of 200 to 300%. So what base we have considered for EBITDA margin? Because from 25 to first half of 26, we are already down 350 basis. So whether we should take 14.8% at the base EBITDA margin, and from there we will improve 300 basis over next 5 years, or we should consider 11% at present. That is number one. And this merger-related expenses, how long it will continue, so that our reported PAT and adjusted PAT should remain in line. Thank you.
So, Mr. Dhananjay, first of all, thank you for the 2 questions. Your first question, the benchmark for the long-term margin expansion is FY25, which we had clarified earlier also. And to your second question, the merger-related expenses are done in this current quarter, which is quarter 2. Does that answer your question?
Okay. So in H2, we should, because we are entering into this digital and AI space, which is more of the non-linear in nature. So can we expect improvement, gradual improvement in EBITDA margin from next quarter onward?
Yes. So, Mr. Dhananjay, given our accelerated growth and the changing mix, we should expect the margin expansion. And as we had highlighted earlier also, when we exit this financial year, which is quarter 4, we will start seeing that expansion becoming evident.
Okay, that is all my message. Thank you.
Yeah. Thank you. Thank you, Mr. Dhananjay.
Thank you. The next question comes from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Thank you for the opportunity. So just wanted to understand that in this quarter, margin has compressed 360 basis on a year-on-year basis in H1. So can you break down the bridge to your target 200 basis expansion, and what proportion comes from pyramid optimization and AI-led productivity or offshore leverage? And second, like on this, also you have guided 2x improvement in billing realization per FTE by 31. So what specific levers will drive this? Is it higher pricing, automation, led productivity, or pyramid optimization? Just wanted a clarity on this. Thank you.
Jyoti, thank you. Let me take the second question first. So the revenue per FTE improvement will come from 3 levels. First is change in mix in favor of digital and technology. Second is more international revenue. And third is leveraging automation for our delivery, for our operations, so that we can eliminate some of the low value work and move the realization per FTE. So that's on the how we see the revenue per FTE expanding over the 5-year term. On the question about the margin expansion, I can share that and will request Suraj to add to that. Jyoti, you are absolutely right. There are a couple of levers. In fact, the 5 levers that I highlighted are actually part of that revenue expansion. I can, talk more again about each of those. So one is the service mix. As the service mix improves to more tech and digital and more international, that will have an effect on the margin expansion. Operational excellence through automation, process optimization, and pyramid optimization is the other one, and deal qualification upfront, so that we are not taking on, deals which are not margin accretive, so we want to eliminate that. Hopefully the investors will remember that at the beginning of the year, we did take a very conscious call to exit some of the low margin revenue, So going forward, we do not want to bring more deals with lower margin. And then, of course, strengthen the revenue assurance and cash conversion. So as an impact of all these 5 levers, we are confident of the expansion in the long term. Suraj, do you want to add to that?
Yes, that's right. So thanks, Jyoti, for the question. So like we had spoken earlier, the mix into our tech and digital business and alluding to the earlier question as well, more AI-infused offerings, we already seeing tractions of margin expansion in our existing portfolio with more tech-infused businesses. And the international growth is also coming in the right trajectory as we had guided to, so that also gives us confidence that the margin expansion is more real. And coming back to your first question, the year-on-year comparison would be slightly incorrect because most of these costs, which investments we are doing in this year, would be not there in the previous year, and also as most of the corporate-related costs as an independent company would not be there in the previous year's result. So I would probably say that will be less relevant in comparison. If you normalize all of them, we are very much on track. And now with the pricing and the other levers we spoke about, the margin expansion is something which we see by the end of the year already giving traction to.
Okay, thank you, sir. Yeah, so just on the international side, like currently we are having 37% of revenue that is coming from international clients. So with a strong US base, so are you observing any pricing pressure or deal delays in discretionary spending from the BFSI and tech sectors?
So Jyoti, yes, there are some macroeconomic headwinds. However, given that a lot of our business in the international market is platform-led, we've been partially insulated, but I would not discount the macroeconomic headwinds of the U.S. as a geography. So in fact, despite those, we've been able to grow our international revenue 6% sequentially and 4% year on year, is probably a testament to the strategy and investments that we made upfront, and we very carefully chose the markets. In fact, the 3 markets that we are focused on, which is healthcare, BFSI, and fast growth tech, one, they have relatively large addressable market. Secondly, especially healthcare and fast growth tech are growing double digits. Financial services, though it may not be growing that much, but the size of that market is huge. And through our differentiated AI-first strategy, we are able to, make entry. And once we make an entry, we have a track record of expanding.
Okay, thank you so much, sir. I will come in.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Zaki Nasir from Nasir Investments. Please go ahead.
Sir, can you hear me?
Yes, sir, we can hear you.
Yes. Sir, good morning, and I think this quarter we've seen a stable set of numbers. But anyway, you all had indicated that for Digitide, H2 will be much better. So do you see the green shoots of improved performance in H2? My question would be, sir, what does 24 new logos and 50% of the new deals being AI-enabled mean for you, sir? I mean, could you explain that a bit? That is number 1. Number 2 is, sir, we said EBITDA margins will look up 2-3% over March 25. So that would mean 14 plus 2-3% up to 2030% a year. Would that be a right interpretation, sir?
So Mr. Zaki, first of all, thank you for joining us and thank you for asking very insightful questions. So let me address your margin question. So that guidance of 200 basis point expansion was the long-term guidance by FY31, and yes, the baseline there was FY25. So you are correct there. So your second question on, are we seeing green shoots? Absolutely. Even in this quarter, we have grown 4% sequentially and 7% year on year. Within that, our tech and digital has grown 23% year on year, and our international has grown.
Sorry to interrupt. Really sorry to interrupt, but Zaki, from your end, there is a disturbance.
Yeah, it's okay now?
Okay, perfect.
Yes, it's okay, Mr. Zaki.
Is it okay now?
Yes, we can hear you clear. Yeah, and there's no background noise. So Mr. Zaki, as I was saying, that we are already seeing the revenue growth, and in the areas that we want the growth to happen, which is international and tech and digital. Now, your second question was, what does 24 new logos mean? They mean an opportunity for us to scale with them. 70% of our revenues come from customers who have been with us for 5 years plus. So what that means is, once we start a relationship with a customer, they see value and they grow with us. So growing with select customers is a very conscious strategy, and the 24 new logos will give us the growth momentum in the years to come. Your second question was, what does 50% AI-infused pipeline mean? So look, Mr. Zaki, we are leveraging AI as an opportunity. So what I mean by that is, we are building AI-led solutions right from hiring, training, operations, and we are embedding them proactively in our solutions. It helps us in multiple ways. One, it helps us to differentiate our solution. It helps us to provide enhanced return for our customers, and it also helps us, it helps the customers, the additional savings that they have from these BAU initiatives, those savings they can plow back into growth-led technology and digital projects where we can be a service provider again. So infusing AI into our solutions is absolutely critical. Like I had mentioned earlier, we are all in on AI, and our mantra is any and every offering that we take to the market should be through the lens of AI first. So I hope I have answered all your questions, Mr. Zaki.
Thank you, sir. Thank you, sir, and best wishes.
Thank you. The next question comes from the line of Pulkit Chawla from B&K Securities. Please go ahead.
Thank you so much for the opportunity. So first question, I think in the opening remarks, you did allude to that there was some softness in BFSI because there was some weakness in BPM. Could you please elaborate a bit more on that, because none of your peers at the moment have mentioned any sort of softness. So was it something client specific or any other issue? Second, if you could also help me understand what sort of headcounts are today is the company with, what's been the trend over the last few quarters as such, and is it a right lead indicator to look at this point of time, given the way that you're changing your model also? Thank you.
So Mr. Chawla, first of all, thank you for joining and asking this question. So the software that we talked about or we mentioned is, in the domestic market, a significant part of our business is collections business, where we collect on behalf of the banks. As you know, in the quarter that went by, there were devastating floods in Punjab, Haryana, Uttarakhand, Himachal, and parts of Uttar Pradesh. So those limited our ability to collect on behalf of our customers. which kind of reflected in the softness. So that's what we were alluding to. As regard your question on what's the headcount, at the end of, so Suraj, you want to take that?
Sure. Thanks, Mr. Pulkit. So headcount as we end Q2, we are at 56,324, which is almost 2% growth quarter on quarter. So this continues the pattern where we grow on our domestic business, on the CLM business on a consecutive basis.
Thank you so much. Thank you.
Thank you. The next question comes from the line of Pratap from Mount Intra Finance. Please go ahead.
Hello. Thanks for taking my questions. Am I audible?
Yes, sir. You are audible to us.
Yeah. Hi. So I just wanted to ask, last quarter we had pointed out that we are doing an AWS deal where we had picked up a multi-year, 3-year deal where we're kind of helping them migrate and modernize. And this quarter again, we've pointed out that we've got a tier 1 partnership with AWS and Azure. So I just wanted to understand what is our growth expectation from this area and what is the how are we kind of changing our work profile, since you're saying that we'll be, investing in kind of improving our offering. So what is our outlook on this front?
So, Mr. Pratap, thank you for joining and for your question. Yes, we did sign a banner deal last quarter, and we've started the transition on that this quarter. That was actually an enabler for us to fast-track our partnerships with the hyperscalers. So the partnership with the hyperscalers helps in multiple ways. One, it will give us early access to any AI innovation. Second, the cloud is the bedrock of AI. I mean, most of the AI initiatives are built on cloud, so we will now be able to participate in those deals. Third is being a tier 1 partner, which, by the way, only a select few partners are tier 1 partners globally. It also gives us access to some co-investments from the hyperscaler. Depending on the nature of the deal, sometimes the hyperscalers would want to co-invest in that transformation, but they do that only through tier 1 partners. So that's why, we are very excited about this partnership. And obviously, this partnership was built on the capabilities that we invested in upfront. So, and already if you see our tech and digital business, this quarter has grown 16% sequentially and 23% year on year. So we are very confident that business will continue to grow double digits on a year-on-year basis. And that is actually our long-term strategy that, our tech and digital share should be higher than where we are today. Does that answer your question?
Yeah, understood. So as you said, in our strategy, the 5 key areas, one of the areas was investment in talent. So are we hiring different kind of talent for this kind of work, for our hyperscaler relationships? Because as I understand, one is our main collections area where we are having some kind of, as you said, we have onboarded some people. And for this kind of work, do we have to hire some maybe different profile of people?
Yes, we do. And we have been doing that. We've hired a very senior leader to run our AI and the solutioning. That's just one example I'm taking, but under him, we have hired people with background in cloud technologies. In fact, as I had mentioned, Google ran an AI hackathon, which has actually come in the Guinness Book of World Records. It's the largest hackathon, and our team won. So that is a reflection of the kind of investments that we have made in the talent, the kind of investments, and we have made those investments very consciously upfront. So you're absolutely right. Now, I also want to tell you that we are not just relying on bringing talent from outside. We are also doing a very large upskilling program, DigiWave we call it. In phase 1, we are actually upskilling 10,000 of our employees. The upskilling profile and the path is based on their current role and their current capabilities. So it could be a beginner to advanced. In the last quarter, the number of certifications that our employees have successfully completed on whether it is Azure, AWS or Google is a reflection of those investments in training and development, in addition to bringing new kind of talent in-house. Does that answer the question, Mr. Prasad?
Understood. And just one last question. So I know it's still probably early days, but by when can we see this kind of translating into better TCV numbers for us, coming down to the proof of pudding that we start winning maybe larger deals or more multi-year deals? Is there any kind of timeline that we look at, even if it's early days right now?
Yeah. So Mr. Pratap, 2 points. One, this is the third quarter where our TCV bookings have been 500 crore plus. In fact, in this quarter, our bookings were 5% higher sequentially. These large transformation deals also have relatively longer sales cycles, could be anywhere between 6 to 9 months. We won a large deal last quarter. We won a large deal this quarter also. So this trend will continue, but to see a quantum jump, it will take 6 to 9 months, which is the nature of these kind of deals, Mr. Pratap.
Okay, understood, sir. Thanks for taking my question.
Thank you. The next question comes from the line of Sanjay Shah from KSA Securities Private Limited. Please go ahead.
Good morning, gentlemen. So thanks for opportunity and really very happy to understand about the talent pool which you explained about our company, and really excited to see our company from year on. So I have only one question. I need to understand the basic metrics of the working of our billing. That is, how much is the performance-based billing and how much is the fixed contract what we do with the customers, and how that works.
So, Mr. Sanjay, first of all, thank you for joining and thank you for your kind and encouraging words. Really appreciate that. So, Mr. Sanjay, we have 3 kinds of contracts at a high level in our business. One is time and material. So, a lot of our technology projects and some of our BPM contracts, especially in the customer life cycle, are time and material. The second billing model is fixed fee. Again, technology projects tend to fall in the fixed fee category. Third kind could be outcome based. So, for example, collections business that we do, a significant part of those contracts are outcome based. What that means is our fees is contingent on hitting a certain threshold. And then the fourth kind of contracts, which probably might be unique for us since we also have platforms, is really per transaction, where we have platform plus services. So the exact numbers, I can have a rough order of magnitude, but we can always get back to you. I think our T&M is about 40%, fixed fee is about 30 to 33%, transaction based is about 20%, and the remaining roughly 10% is outcome based. Mr. Shah, does that answer your question?
Yes, sir. Very helpful, sir, and thanks for replying questions, and good luck to you and best wishes, sir.
Thank you, Mr. Shah.
Thank you. The next question comes from the line of Ankit Dharamshi from RNM Capital Trust. Please go ahead.
Hi, good morning. So, my question is regarding the mix. I mean, we have been guiding that in a longer term, we will be expanding our margin with the improved mix, with custom digital contributing higher. So, I wanted to understand, this quarter, our tech and digital mix has went up by 3%, but our EBITDA margin on Q1Q basis are kind of down. So, I just wanted to understand why, I mean, in spite of tech and digital contributing higher, why our margins, EBITDA margins are lower. And second question is that our unbilled receivables went up by around, have almost doubled. So just wanted to understand what is the reason for that. Thank you.
So, Mr. Ankit, thank you for joining and thank you for your questions. So I can take the first question. The tech and digital business or the contracts, they have an upfront transition. So typically in the first quarter of execution, you don't see the impact. The margin impact is always backloaded in these projects. So that's the reason that you see that anomaly. I wouldn't call it an anomaly. It is the nature of that business. It's very consistent with the industry. On the second question, Suraj, you want to?
Sure. Yeah, thanks for the question. This is Suraj here. So if you look at from a unbilled movement, what we had done before our demerger, which was effective April, was to maximize our billing to the customers because we were anticipating a lot of contract innovation, GST registration, etc. need to happen. So we had accelerated most of our billings to our customers and accelerated our collections also in our March quarter. And after which, as predicted, we had faced quite a bit of challenges in the first quarter in terms of our billing. But we have covered quite a bit of the distance back to normalcy in Q2. So while it looks from a March to September, you would find that increase. Actually, we are closer to a sort of a 1 month billing. So our unbilled DSO is close to 33 days at the moment, which is almost like just last month's billing. And we are further improving that with our accelerated collection mechanism, which Gurmeet spoke about in the coming quarters. So from a quarter-on-quarter comparison, it looks high. Even Q1 it had gone up, and we have retracted successfully to the baseline as of now. So we would only be further improving from that baseline. Does that answer your question?
Yeah, got it. Thanks for the clarity.
Thank you very much. Okay.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Varun Pinto from N Capitals. Please go ahead.
Hello, hi sir. Am I audible?
Yes, sir, you are audible.
So, sir, I know we have guided for, 200, 300 bits margin improvement, by FY31. But currently, our margin has dipped significantly. Do we expect our margins to at least revert back to around the 14% range in FY27? And what do we expect, to exit FY26 at? What kind of margin?
Hello. So, thank you, Varun, for the question. So, yeah, you're right. Our long-term guidance is for 200 basis points higher margins by FY31. So, we do not give an interim guidance for 27 as you're asking, but just to give you a trend, like you would have seen, most of our investments, leadership capabilities, and demerger-related costs are now behind us. So, we should be seeing an uptick later by Q4 of this year for sure. And this is consistent with what we had guided to the market, that while the overall FY26 margins would be impacted by this transition and the investments, we would start seeing that positive uptick from Q4. So we stand committed to that guidance and will see some uptick there.
Understood, sir. And the other question was, sir, that, to achieve our 1 billion target by FY31, assuming that FY26 is going to be sort of a flat year for us, we have to hit sort of a 22-23% growth rate from next year onwards. So is this growth going to come, towards the back end, to closer to FY31, or do we expect it to happen more in a linear fashion starting from next year onwards?
Mr. Varun, thanks for your question. This is Gurmeet here. Yeah, so FY26 actually is not a flat year. And we believe we will, as we exit Q4, we'll actually be on the double-digit revenue growth. So if you recall, when we had laid out the blueprint for $1 billion, we had said that the 650 million incremental revenue, two-thirds of that will come organically, and about a third or about 200 million will come inorganic. And so on the organic, we need to be growing in the 15 to 16% range. So if we exit this year at 10%, we should be accelerating that in the coming years, getting close to that 16% mark. And then on the inorganic, as I had mentioned in my opening remarks, we are actually looking at a couple of targets, and that is a key part of our strategy, which will help us get to the $1 billion mark or the $1 billion goal that we have set for ourselves as a team by 2031.
Perfect. Thank you so much, sir.
Thank you.
Thank you. The next question comes from the line of Jyoti Singh from Arihant Capital Market Limited. Please go ahead.
Thank you for the opportunity again. We have added 24 new logos in Q2. So with TCV booking of 550 CR, what proportion of this means are transformative versus run the business contracts? And are we seeing any higher deal tenure in AI-led engagement, sir?
So Jyoti, thanks for your question. So, at a very high level, our business is technology and data, BPM, and payroll platform-led business, right? So the growth is broad-based across all the three business lines. Obviously, we have seen a little faster growth on the tech and digital and the payroll platform. So it's consistent with our hypothesis for growth. And then your second question, that are we seeing slowdown on the AI deals? Look, the AI deals, Jyoti, I will put them three kinds. One,
sorry to interrupt you, sir. It's not a slowdown. It's seeing higher deal tenure in AI engagement, AI-led engagement.
Oh, you mean the tenure as in 3 years versus 5 years?
Yes, sir.
Okay. Sorry, I misunderstood your question. So Jyoti, if you see, in the industry, with the pace of change of technology, a lot of customers have now started to gravitate towards 3-year deals with option for 2-year extension. So we are seeing a lot of 3+1+1 deals. About 3 or 4 years back, there used to be, majority of the large deals used to be 5 years. But with the pace of technology change, I think most customers don't want to lock themselves. So what we are seeing is the median deal term is in the 3-year range for the larger deals with an option to extend 1+1.
Okay. Thank you so much, sir.
Thank you, Jyoti.
Thank you. As there are no further questions, I would now like to hand the conference over to Rajesh Lachhani for closing comments.
So, thank you, Jyoti, and thank you, Hina, for hosting us. And thanks, everyone, for joining this call. As Gurmeet said, we are seeing green shoots. Our tech and digital revenues are going up. The share is going up, and our international revenues are going up. So we are on the trend that we had already guided. Most of the expenses related to demerger are now behind, and so that is also, you will see better performance going forward. With this, I will close this call. Thank you.
Thank you, everyone.
On behalf of Arihant Capital Markets Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.